Mike Points, how's it going? Thanks for joining me today. I know we've had some changes here in the mortgage rates, a little bit of a reduction there, and I just wanted to hop on a quick video with you so you can educate our audience as far as why that happened, and then what that means for maybe quarter number 3 and 4, and just some ideas you have for some buyers out there. Should we wait? Or should they buy now where there's less competition? But go ahead and, if you don't mind, give a quick introduction of who you are, and then let's get into it. Why did those mortgage rates drop, and where are we at right now that we're in the second week of August?
Yes, excellent. Thanks for having me, Josh. Everyone, I'm a mortgage loan advisor here in California. I'm based right here in the beautiful Central Coast, and I've been on Josh's recordings before, but if you're meeting for the first time, I really do enjoy the macro and microeconomics of this business, this industry. So if you recall, as we went into the end of 2023, there were serious predictions about the Federal Reserve making rate cuts in 2024, this year. Well, the PCE reports came out as months went on. The unemployment rating stayed pretty low. We got all the way through up until, I would say, early spring, mid-spring, and no talk about a rate cut at all. So even though there was no rate cut and there was good economic data, behind the scenes, businesses really did continue to hurt, and the economy was teed up for a rate cut. They never got one. So if you're going to keep giving downward pressure, eventually things are going to go down. And the unemployment rate since May has been 4%, which is perfectly normal in a good market. But now in June went to 4.1, in July 4.3, very quickly increasing the unemployment. And another great thing to watch is how many people are filing jobless claims and staying unemployed. So there's not a strong jobs market anymore where people can, quit or lose a job and replace their job within 1 to 2 months. What's really sad too is that we're also seeing no more poaching. Poaching is when you take a employee from a competitor employee or a crosstown employer because you can offer them better wages. Wages are going down as well. So all that it's unveiled. And the economy sees that as a very big concern. As jobs are lost, we have to predict that maybe a recession is coming. So we saw interest rates on the 30-year note go from so this is last week, the first week in August. This is the second week. Last week on Monday, 6.81%, Josh. By Friday, they were 6.4%. It's a huge decrease, and that's the lowest we've been in quite some time, last 12 months. And so that is really what's happening right now. And the reason it's coming down and coming down sharply is because the market is saying we could be entering a recession. There's no talk of recession, but it's a high possibility.
Thank you for sharing that. So let's talk about an individual buyer out there who maybe has been a little bit discouraged with the lack of inventory,
Yeah.
the high level of competition with other buyers. Maybe they've decided, San Luis Obispo maybe can't quite get in there for a first time home, single family home. Maybe now they're looking at Atascadero or Grover Beach. Talk to me about what maybe a suggestion would be. And of course, we know that your life situation dictates whether or not you make a move or you buy a house. So if you just recently maybe got a increase in your pay or promotion through work, or you got a new
First
job.
baby.
Yeah, you got a new baby or dog and you need to just expand. So we know that those are the factors that really decide whether or not you're making a move. But let's just talk through that. You've been discouraged as a buyer. You're looking to buy your first house, single family home here on the Central Coast. You've got a budget of $850,000. Maybe you've got 10% down. Right now, the competition maybe is a little bit less because the interest rates have been a little higher. There's not as many buyers out there. The inventory is creeping up. But as we head into quarter three and four, if interest rates drop a little bit more for the mortgage, for the mortgage rates, that might bring in some more buyers and bring those prices up a little bit more because there's more competition. So walk me through that. Should somebody, what's the difference between, what's the advantage between buying
Yeah.
now versus waiting?
Yeah, interest rates are in this current climate, interest rates are a double-edged sword. And what I want to talk about quickly just to define that is clearly higher interest rates make the housing payment less affordable. What they do in that scenario at a higher level though is they wipe out your competition. There are a lot of people who just cannot afford or cannot qualify for a house in a neighborhood that they're willing to move into. Maybe they have the baby, maybe they've got the job upgrade, but they haven't shown enough. Uh, they haven't made enough income yet, or they haven't saved up enough money to get into that neighborhood they want to. So they're staying renters. That's good for when you go to make an offer for Mrs. and Mrs. Jones, Mr. and Mrs. Jones to look at your offer. Okay. However, payment's going to be high. Now, the other side of the sword, and what I think is going to be the sharper side of the sword, Josh, metaphorically speaking, is that when rates come down to 6%, many, many people are going to get off the couch and start making bids on houses. And there will be more inventory initially. There will be more inventory because as we're already seeing in this higher interest rate market where we just stayed stagnant, houses are staying on market longer. When these rates start dropping, they drop fast. I just told you last week, 6.81 to 6.4, 5 business days. So I think what I would do if I were you, if you're a first-time home buyer, like 5, 10, maybe 15% down, you really have to force yourself into the market right now. And you shouldn't feel forced to buy the number one long-term house. Just get a good house. A good house is a house that has all the right bones, has good curb appeal, but just get it now because in the next 12 months, you're going to see the price of that house jump up quite a bit when rates come down and buyers can continue to now come back to market and make a bid on your house. I just think I want to stop there, Josh, because there's so many things else I want to talk about with regards to numbers and figures, but that's really where I see buyers are perplexed. They're thinking, I don't want to pay $5,000 to almost $6,000 a month for a housing payment, but if I wait, my payment from 7% interest rate to 6% interest rate is going to go down about $500-$600. But what's going to happen to price if I wait?
Yeah, that's a great segue into this last question here, pivoting from, let's say, buyers, first-time home buyer, to maybe a seller that's selling their first house and they're looking to buy an upgrade house, or maybe they have owned a house and it's 3,500 square feet and they're looking to downsize because maybe they're looking to retire. And they just don't need that much space, but they have some debt on the new house. Let's say,
Sure.
thinking, well, now the inventory's levels relatively low. A lot of, not as many homes on the market, so not as much competition as a seller. But I'm also a buyer. I'm a seller and a buyer, and they're looking, to relocate here to the Central Coast. So they're maybe selling in Paso, buying in Pismo Beach, let's just say. So, kind of
Sure.
scenario for them. I know for me as a broker, we're seeing that inventory level tick up, but nowhere near what we saw in previous years. And we're still the average original price or original percent of list price to acceptance and close price is around 97, 98%. So still fairly strong demand for houses out there. What are we thinking? Should they be waiting? What would be the advantage of waiting, listing maybe in next spring and then making that move next spring, or listing now where there's still less inventory, still relatively high demand for housing, and then going to get that replacement property? Just walk me through that with these when we're talking about the interest rates and what we've seen.
Yeah, yeah, I think so. Um, to summarize this with regards to how the interest rates will affect you, seller, I think right now you're going to have to be patient and have your house on the market for probably 45 to 60 days. There's just a lot of turmoil right now. We're in this calming of the storm where buyers haven't seen rates go down enough to get excited to go back, but it is on the forefront of everyone's mind. I can assure you, I'm contacting my first-time home buyers and saying, "Hey, are we ready yet? We need to get ready. Let's reshuffle our pre-approval. Let's get everything in. Let's get ready." If you're a seller, you want the biggest auction floor to make bids on your house. The more that Josh can incentivize buyers to buy your house, the better. And one thing that's not in Josh's control, but will help him sell your house, is that if interest rates drop to 6 or below 6%. Now, if I knew exactly when that was going to happen, Josh, I'd probably be doing this video from my personal yacht. But I don't. So it could happen as early as December. Wouldn't that be weird? Like when you're going through the holidays, all of a sudden there's like a real estate boom. We have no idea. But I will say this, if you do get a little too greedy, seller, when you go to sell your house and you need to replace it with a new house, guess what's going to happen? You're going to be a contingent buyer up against 4 or 5 different other buyers. Not only the first-time home buyer, but here's what I see: a first-time home buyer coming in at a price point from $850 to $1.2 million. Guess what? Grandma and grandpa are giving them an early inheritance. They're getting 20, 25, 30% down, and they're not contingent. So you have to make your house offer price higher just to distract the eyes of the seller to take your offer. And guess what? So you sold your house for more, but you're buying your replacement house for more because of the situation you're in. So if you're contingent to replace, that's dangerous. I think you would probably just want to sell now, get in, think like the first time home buyer that's trying to get in without competition. Josh, you and I did a transaction just recently where someone lived in a house for a long time. They were able to get their house with the market as is. They have a very cool house. They were able to get a buyer and then go to the open market telling the seller for the house they wanted to buy, "Look, we already have a buyer. They're ready to go. They're just waiting for us to find a house."
That's a great example that we just went through. And to your point, we were the only offer on that replacement property, and we'd already secured the buyer. And so it was sort of a best of both worlds for our clients. So it worked out well for them. And I think you're right that right now, as we see inventory tick up just a little bit, if you're a seller looking to buy a contingent property, you do have some more options than you maybe would have seen last year. It's not quite as competitive as we saw in 2022, 2023, with houses for sale going above asking. Now they're just a tick down on
Mhm.
average, below asking, but still very strong, market out there, especially for well-priced homes. So I think you make a good point. Walk me through, just to close it out, what should people be looking for in regards to another reason that mortgage rates would reduce? I know we talked a little bit about that before this call in regards to the Treasury, the Treasury bonds and whatnot. I know that's separate, but what really dictates
Sure.
these mortgage rates to drop now as we head
Mhm.
into quarter 3 and quarter 4? Is it really coming down to the bond yields? Is it the unemployment? What should we look for as an indicator that we're going to see some reductions again?
Yeah, I think the number one index or number you should be following right now that's going to really force the hand of the Federal Reserve. Jerome Powell's a chair, but the Federal Reserve as a whole, to reduce their Fed funds rate, is going to be the unemployment rate. They have a dual mandate. which basically means they have to use interest rates to bring down inflation, and they also have to use interest rates to make sure that unemployment doesn't run rampant and go too high. What's scary about the unemployment right now is it's at 4.3, and you're like, what's the big deal? That's like, 3 basis points above its normal, like, great economy level. But many people are not going back to work. So we could stack on top of 4.3 very quickly. If that thing comes out in September and goes to 4.5, which would happen in the beginning of the month, jobs reports from ADP and the BLS report usually happens within the first 6 to 8 days of the month. That month, later in the middle of the month, the Fed's meeting, I almost assure you that if that thing goes to 4.4, we're going to see a half a point interest rate cut on the Federal Reserves. And that's going to tell banks, okay, we have begun the system of reducing rates over the next year. So we need to start adjusting our 30-year mortgages to account for what's going to happen the next 6 months, not just right now. So we could see a drop to 6% flat, Josh, before St. Nick comes down the chimney. And that would be, for some people, that'd be a great Christmas. But for all of us that didn't think we were going to buy a house in December, you need to be ready for that. Unemployment's a great thing to watch over the next couple of months. Now, hey, it's not a very attractive or sexy thing to watch. In fact, it's pretty sad for some people to lose their jobs and not get a replaced job. But remember, you're watching it from the standpoint of the Federal Reserve has a duty to make sure that that rate doesn't go too high. They can only use interest rates to bring the rate back down. So they'll incentivize the economy to go out and borrow, to buy things, and then employers need to hire to sell the goods and services.
It's almost a remedy for some of the other problems. It's more of a solution to those unemployment tick ups there. Thanks, Mike, for taking the time. I'm going to put your contact information there for anybody who needs to reach out. Highly recommend Mike Points here from Motif Mortgage, and he'd be happy to sit down with you and walk you through what he can offer through all of his different programs. Any final thoughts there, Mike, before we close out?
I just think it's really an important time to, be grateful for what you have and be thankful that in this country we live in, things are tough and unaffordable, but we have a really great place to live, especially here on the Central Coast. So, this stuff can be very stressful, but we're pretty blessed to have what we do have.
Attitude of gratitude. I appreciate that. All right, Mike, thanks for hopping on. Appreciate you.
You bet. Bye, John.